Hey everyone, my name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in there, take a look, see what's going on today. We've got, if you want to follow me at _Score Finance, and if you want to join our community, finding-value.com, I dive into all of these topics, looking for potential investment opportunities, sharing those opportunities with everyone in the community that's there. You can see my portfolio, what I'm buying, what I'm selling. I share that everything on the website there. So Bitcoin Teddy says, Fink, I was wrong about Bitcoin. When the CEO of BlackRock, managing 13 trillion in assets, admits he was wrong, you listen. BTC is in the history in the making. I'm getting a lot of stuff in my feed about Bitcoin. Obviously, people know my opinions on it, but I'm just going to say this. I wouldn't use his opinion necessarily for anything. This dude is pretty bad. Bad as in like evil. So be careful what this guy does and what he gets his hands on. That's all I'll say. Market Sniper says problems physically held gold owners are not worrying about digital scarcity, quantum computing, hard forks to preserve funds. And this is Willow. Willow is a chip that came out. It's Google's quantum chip that solved a 30-year problem overnight. And in 6 years, it could change. So here's how to prepare for it if it's too late. And I'm just letting you guys know that quantum computing is being developed, come out with some pretty crazy stuff. Coming down, it says missing fake oil glut from Peter. He says, if found, research, IEA or BBG offices, paging all oil bearers. It says, I was told Brent oil was headed for a five handle, 50 something dollars. So some people, we're short, we're tight on inventories. We are about $15 underpriced in relationship to history for commercial inventory levels. And that's kind of where we're at right now. Um, could people be pricing in a potential slowdown or a recession? Maybe, maybe not. I don't know. Tough to say. Tough to say. That's not what we're seeing in yields. The yield curve, yes, but not in yields in the direction of yields. Generally, when we get a slowdown, people run into bonds and yields drop. They don't go up like they are. Jacob King says another 1 billion USDT has been minted out of thin air by the Tether treasury and injected into Bitcoin. Notice how unstable and weak Bitcoin is, but the moment they mint and inject, things start flying. Not sustainable. I don't know. I just see this stuff on my feed. I share some of it for you guys. And I will include this because that's what it seems like everyone is interested at the moment. I buy stuff where I'll just say this: the stuff that I buy is not conducive for a YouTube channel because if you're a good investor, you're going to be buying things that no one is searching for. They're not searching and actively searching for that sector or that asset class. Generally, if something is very popular and everyone is searching for it, that's when you want to sell or start to think about getting out of that sector or area. So right now, when everyone is all beating their chests on Bitcoin and certain other areas, and there's a lot of searches and interest in it, that's generally when the top is near. Rock bottom entries, silver seasonality, we're at rock bottom. The stars are aligned for a massive move in the months ahead. And silver futures, seasonal 37 years, we're here. We've got a nice big move up for the rest of the year. And then in the beginning of January and in February, that's generally where we get our move higher. So silver futures, seasonal 37 years, the best time to be invested is basically where we are today and all the way till mid-February. Invest in assets. Everybody wants a 10 bagger, but no one wants to hold when the stock drops 50%. Now, there are times where stocks go up 10 or 20x and don't have large pullbacks. There are those rare times. Most of the time, if you're in it for a 10 bag or 20 bag, or even if you're lucky enough to experience something over a 100 bagger, you're going to see multiple times where the stock drops 50% or more during that holding. Most people cannot hold through that. They sell it somewhere. So they're destined for crappy returns because they're never able to ride out a really good company for a long period of time. Warren Buffett, what his uncanny ability to do that sets him apart away from everyone else is it's not him being the best stock picker. What he did and what he did really well is that he put a lot of money in a few companies that did very well, and then he was able to hold on to them forever. Coca-Cola being one of them, um, See's Candy, and there's other ones too. So he obviously has experienced many big drawdowns through that time frame. His patience is what gives him the ability to outperform and his ability to find good stocks to basically hodl onto, hold on for dear life or forever. So that's what sets him apart from everyone else. And there's personality traits, I think, that may help people do that. And then there's personality traits that are going to work against you taking that approach. The majority of really successful people have been able to hold on. Peter Lynch, that's him here. Uh, he's one of the people that was successful at doing it. Warren Buffett, Charlie Munger, Manish Pabri, who studied those guys, um, they've all been able to do that. And I've listened to some of these guys, and even Manish, he said, his biggest weakness, and it was similar to me, surprisingly. I just, listened to it. He says some of these companies, even though he had, 5 times his money, he sold too early. He said they went on to be 100 or 200 baggers. And his biggest, I guess, regret was not holding long enough. And I was like, wow, that's pretty much the same thing that I came to my conclusion is I sold out, hundreds of percents higher when I could have gotten a 20, 30 bagger versus my 300% increase or whatever in the stock. So yeah, seems very similar to me as well. Trump is inheriting a ticking time bomb. A new administration really has their work cut out for them, cleaning up this inflation mess. And there's the big move of the inflation mess that he is referring to. This is where they think we are. It says you are here with Powell and company cutting rates on top of an already tapering QT to artificially reduce yields on the treasuries, which could set off another inflationary storm in 2025. I'm in the camp that this was, it doesn't matter who's in power, it's going to happen no matter what. It deals with demographics, the real estate market, et cetera, et cetera. JSG, it said added proper standard deviation curves and event sigma description to the comparative inventory plot. The EIA data for week of 12/11/24 shows commercial inventory, excluding other oils builds of 4.6 million barrels. Latest WTI fair value price of $85 a barrel, or $15 undervalued. The current pricing is a negative 1.5 sigma event. So these would be 3 sigma events way out here. This is a 2 sigma event, and then we're at 1.5. So we're cheap, but we're not way out there. That looks, it's good that we could buy oil related equities when it's this cheap. That's good. We don't want to be buying it when it's overvalued. Doesn't mean we cannot have a slowdown due to interest rates, but this is the current situation for our housing market. It says as of June 2024, the United States is short 4.5 million homes. An explanation is the U.S. housing shortage grew from 4.3 million homes in 2021 to 4.5 million homes in 2022. This is despite a construction boom during the pandemic. The causes are The shortage is due to a number of factors, including in 2022, the number of families in the United States increased by 1.8 million, while only 1.4 million housing units were built. Popular markets are drawing in new residents faster than new housing can be built. Land use regulations make it harder for people to afford mortgages in some areas. The impact here is when there aren't enough homes, home prices and rent increase. The solution is to close the gap. The supply of single family and multifamily homes needs to increase. Some say that the rate of housing starts would need to triple to keep up with demand. This is asking AI that question and AI pulling up that information. So some say that the rate of housing starts would need to triple to keep up with demand. Think about that. So some people say, well, why are we building inventory on new homes? Well, maybe it's the affordability that's a problem. We still have the demand, we still have the people out there, but that doesn't mean that this demand for 4.5 million homes is going to be met immediately. It depends on how much they cost and what the interest rates are and what the affordability is. But I will say this, we don't have a bunch of foreclosures. We have nothing like the same setup in 2008. 2008, we didn't have this shortage. We had an overbuild situation. We don't have an overbuild situation. We can pile into new home builds where we accumulate more new homes unsold. But that also has an impact of affordability tied to that. And with interest rates going up as fast as they have since 2020, it is impacting the affordability, and we can see that in the inventory of new homes. But existing home inventory is not very high at all. So we're not in a bubble based off inventory. But new homes are going to have to make up a big chunk of this. And that's why we're seeing a lot of the home builders starting to break out of these big patterns and make new all-time highs. This is the reason behind it. And this also is when you get a commodity boom. It's during this market condition here. So actual solar installations are more than 3 times higher than 5-year forecasts. So I guess solar PV is just ripping. The way I view it, increased silver demand. Increased silver demand. So here's Kevin Bambro. Let's see what he is. Says this is a great thread. Says lost is the mindset that hard work is good for you, that you should try to be as efficient and productive regardless of your task. Success comes when we apply ourselves and work as a team. Stagnation in an economy stems from the culture. One of the worst is when people operate on protocol of attempting to do the minimum in order to collect an hour wage they aren't happy with. This creates a huge negative feedback loop. Innovation in a business can come from any position. If you can improve your job, automate parts of it, and increase productivity for all, do it. The best way to rise in a firm is to figure out how to eliminate most or all of your current job. Show those above that you have greater bandwidth. Soon you'll be teaching, leading your division. Your firm will also grow and outperform its competitors. I think that's probably true for smaller corporations. I don't think that's the case for large corporations. And I know that sounds crazy, but what I found with large corporations, it's all who you know, getting buddy, and then just working your way up based off who you know that's way up there. Now, it depends on what those upper individuals, the upper managers or directors or whatever, it depends on what they value. If they value hard work, then they'll promote those people. If they're female and they want to promote other females, well, if you're a male, that's not going to help you. And that's kind of what I've seen and what my experience is. And it's good that you can do innovation. It's good that you can work hard. But you can also cause a lot of problems in your department. So a lot of these big corporations, they have quotas almost, and they have um, certain amount of people that they can promote and not promote. And if you're doing a really good job, like you're just killing it compared to everyone else, it's highly going to depend on your manager, your HR, and the company. They may or may not promote you, and they may or may not give a crap what you're doing. A lot of them will say, well, you need to be in this position for X amount of years before we're going to look at a potential raise for you. So doing all that hard work, what it's going to do is it's going to demotivate you. And what I've found, at least in some of these large corporations, the big boys will call it, you can work as hard as you want, but you better figure out what they think is important. And even if you hit what they think is important, that still doesn't guarantee success or a promotion or even a big raise. They may give you a slightly above average raise. What they want is they just want the job to get done. They want to do it with the least amount of work, generally speaking, the managers for themselves, and that the problems just kind of go away. Um, you can do all that, but that doesn't mean that you will move on up any faster than anyone else. I've seen incredibly good people that are, I'll say, a cornerstone in a department, and they still don't get promoted faster than the average person. So then the question is, well, how do you get promoted? You probably have to switch jobs, and you have to switch, and have to learn all these new systems, which really isn't much value added. Taking on new projects, taking on bigger projects, it may or may not help you. It really depends on the HR team there and your direct manager. Huge deal. Now, if you can gap two people above your direct manager, so if you become buddy buddy with a director that's up and has pull, and they like you, then they can pull the strings to pull you up into a position maybe underneath them or underneath one of their other buddies. And that's the buddy buddy system. That's what I've seen, at least my experience working in these 9 to 5. So I agree with Kevin that success can come from anywhere. Automating what you don't have to do is all this is great, but it doesn't mean that you will move on up. It highly depends on the company that you're in. Warren spends 70 hours a week thinking about investing, says Charlie Munger. Lou Simpson says, we do a lot of thinking and not a lot of acting. A lot of investors do a lot of acting and not a lot of thinking. So when you think about your investments, you should be thinking about it a lot. And then when you go to buy it, it should be at hopefully at opportune times. And then you cost average in or buy a chunk of it at a certain location where it's undervalued. A lot of people just chase price. That's all they do. That is all they do. So is something good or something bad? You'll ask them and says, well, the price is going down or it hasn't gone and moved anywhere. It's a bad investment. Like, well, you got to get the right time frame. Um, and that's the big difference between everyone. A retail investor, most of them, they just chase price. They know nothing about the company. They don't know anything. So they're just dumb money running around chasing stuff. And these guys, they really think about the dynamics of the company and the market. They're good at identifying where the tailwinds are, and then they buy when people are fear. There's a lot of fear in the market. That's what creates the largest disconnect between price and value, and that's where they basically exploit that disconnect. And then they use patience to separate themselves from everyone else. And that's what I talked about. They never sold those, 1,000, 10,000 baggers that they got when they bought Coke way back in the day, and Seas Candy and all these other ones. And they just continued to hold on to it over the many years, providing this value in these companies where they're not in technology where they cycle in and out. They're just boring companies that make a bunch of money that expand the same product out and out and out. Elon Musk says 99% of cars will be electric and autonomous in the future. Manually driven gasoline cars will be like riding a horse while using a flip phone. Still happens, but it's rare, is what he says. So he thinks that most everything is going electric. I'm not sure if he knows what the constraints are in terms of minerals, but that's his opinion. And this is what he said here. News: less than 1% of EV owners switch back to gas-powered cars after making the purchase, according to new global EV driver survey, which includes over 23,000 people from 18 countries. It says reports of declining EV popularity are greatly. Results show that lower operating costs are the most important motivation for buying an EV. This should serve as an eye-opener for policymakers worldwide. Vibrant electric vehicle market is crucial for reducing climate emissions from road transport. Achieving this goal hinges on making EVs an even more affordable option for all, says Ellen Heap, board member of the Dutch Electric Vehicle Drivers Association. Ian Castle. So this is what most retail investors do at a 5 price to earnings ratio. No one likes it. At 10 PE, a few people like it after a good quarter. At 15, they probably got lucky with a good couple of quarters. At 20 PE, 3-4 good quarters in a row, great management, okay business. At a 40 PE, price to earnings ratio, 6 good quarters, outsider management, compounder status initiated, pile in. And that's when you don't want to buy. You want to buy it when no one likes it and nobody knows it even exists. And that's what's difficult about having a YouTube channel, is that you're going to be talking about stuff that no one likes because that's where the risk reward is the best. In this particular scenario, if they've got increasing earnings and their multiple went from 5 to 40, that means that we saw a large increase. This is an 8x here, and then whatever the earnings went up on top of it. So maybe that's a 10 bagger there or a 20 bagger because you got your earnings going up and you got the multiple on top of it. But this is when you want to sell, potentially, if it's greatly overpriced. But that's when everybody piles in, unfortunately. Money wisdom. Peter Lynch says the key to save as much as you can as early as you can. That's the key. So you can compound it the longest time. Stanley Druckenmiller obsesses over position sizing. And it's one of the many reasons why he's generated 30% CAGRs without a single down year. Position sizing is 70 to 80% of the game. And just to go over this real quick, he says, the reason that struck me is because, first of all, purportedly George Soros made money on fewer than 30% of his trades. Fewer than 30% of his trades made money for George Soros. It says, and that alone is worth letting settle in a bit. And he's one of the great investors of our time. So what does that mean? It means that he made a lot of investments that lost money. They probably did not lose much money. And when he did make money, he made a lot of money, both by betting a lot of money and by letting it run simultaneously. That I thought was a really interesting lesson. So he bet big, he took the risk reward, the asymmetry, and rode his winners. That's how he made it. Grady says, and I'm going to keep going over these charts here. It says, this is not only a gorgeous chart, it is also very unusual setup with gold and silver looking this similar. And if they hold the trend line, the way is for both. And they're the 4-year parabolic bases in both of them. High Heat says, at a point fast approaching, additional rigs for oil won't matter. In 1973, oil prices were $3.18 per barrel. By 1981, they were $34 a barrel. The rig count exploded from 993 to 4,500, yet production continued to fall. Decline curve is still king. This is a lesson we're about to learn once more. He probably read the Goring and Rosenzweig article talking about oil depletion and how we could be experiencing that in shale oil right now. Dave Kranzler says the gold price is starting to move inexorably higher. Something ugly is going on in the financial plumbing. It has nothing to do with the muted, in my opinion, geopolitical situation. If the me mattered, the NAZ would have crap today. Something more ominous is developing. So, Josh Young, here's another one. Isn't US shale well productivity still growing? RJ, no. Per foot, it's way down. So, US per foot well productivity is rapidly declining. We were down 10% from 2021, 2022, or from where we are in 2023, and it was down last year 6%. So we're losing well productivity. We are going from tier one to tier two. We are drilling longer laterals. So per well, we are getting more out of it because we're drilling longer and longer horizontals. But our productivity per foot is declining. And this is the beginning of the decline. So get ready. Bloomberg reports MicroStrategy may join the NASDAQ 100, forcing ETFs to buy at least 2.1 billion worth of its shares. Not bad for a company that has lost money for the last 2 decades plus. That's pure value there, boys. And that's what we've got for today. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. That's all I've got for today. So we'll catch you next time. This is Finding Value.